Welcome to the Solution Nation podcast. My name is Sean Snowday, and I'm the president of Solution Nation. Solution Nation is dedicated to providing a platform for investors to learn about Israel's most dynamic public and private companies. We interview lead venture capitalists, Wall Street analysts, investment bankers, and managers of incubators and accelerators. In this podcast, Edwin talks about questionable revenue recognition practices, as well as how to access the quality of board members. We discuss what investors should look for in terms of companies' patents, the turnover of retained law firms, and the role of influencers as revenue generators. Please remember that all content provided on the Solution Nation podcast and website is for educational purposes only. Nothing shall be construed as investment advice. Investment decisions shall not be made based on information, written, verbal, or otherwise, posted or spoken on Solution Nation. Conduct your own research or consult with your own investment advisors before making investment decisions. So here's my good friend, the host of the show, and the CEO of Solution Nation, David Wanatik.
Welcome, everyone. I'm David Wanatik from Solution Nation. I'd like to thank you for joining us today. The focus of this program is going to be on traps in investing in emerging companies. So whether you're considering investing in an Israeli company or another emerging company from a different part of the world, these companies often have a lot of excitement associated with them. They're introducing groundbreaking technologies or revolutionary business models, and they're very exciting companies, and many of them are going to be highly successful, but not all of them. And it does make sense to be a little bit cautious, protect your downside, do some good research, and maybe enter into the investment proposition with a bit of skepticism. So on that vein, I can't think of a better guest to have than our guest today, Edwin Dorsey. Edwin does great work. He publishes the Bear Cave as well as Sunday's Idea Brunch newsletter, where he interviews portfolio managers every week. He's a very young man, but he's already contributed a great deal of knowledge and insight and methodology to investing in small companies. So, Edwin, thank you very much for joining us.
David, thanks so much for having me. I'm really excited to be on the Solution Nation podcast today.
Good. So for those who don't know about the Bear Cave or your Sunday's Idea Brunch newsletter, maybe just take a minute and tell us what you cover in those publications.
So the Bear Cave newsletter is a newsletter devoted to exposing to corporate misconduct. So I look deeply at companies that are misleading investors or harming customers. The core of the newsletter is two things. Every Sunday, I publish a recap of that week's events. So I'll recap new activist short reports. I'll highlight notable resignations or resignations I find a little suspicious and share links and tweets to interesting content. And then twice a month for the paid subscribers to the newsletter, I'll do a mini deep dive on a company that I believe has some issues that aren't being appreciated by the market. So these aren't necessarily short reports, but I'm highlighting problems that I think investors might be missing. So it might be a lawsuit, it might be a suspiciously high number of resignations, it might be some issues consumers are having with their products, stuff like that. And then my second newsletter, which is more of a side project, is called Idea Brunch. And in that, every twice a month, I'll do a written interview with an emerging hedge fund manager I find interesting. And I'll ask them a few questions about their research process, why they love what they do, and maybe ask them to share an idea or two. But the Bear Cave is my heart and soul, and I spend a lot of time looking at bad companies.
Great. Well, I'm a subscriber, and maybe just let people know where they can learn a little bit more about the Bear Cave if they want to take a look at it.
Absolutely. So you can go to thebearcave.substack.com. You can Google the Bear Cave newsletter, or if you just Google me, Edwin Dorsey, on Twitter, you'll find me. And that's where I share a lot of content too.
Okay, great. Well, tell us how you came into being involved with research and the bearish angle to research.
So David, I have a kind of quirky history. I've always been really passionate about stocks from like a really young age. Second grade, I was all about the stock market and very passionate about it. Freshman year of college is when something changed for me. Just by coincidence, freshman year, I got introduced to two of the biggest short sellers in the country. One was Mark Cahodes, who used to run a fund and now does a lot of activism on his own, trying to expose frauds. And the second person I was really lucky to meet was Jim Carruthers, who ran a hedge fund called Sophos. That was a short-only hedge fund that was pretty large. And I interned there on and off for all 4 years of college. They really taught me the ropes, how to research companies, introduced me to everybody in the short world. So that was a great internship as a young person. But then when I was graduating into the pandemic, they were shutting down, so I wasn't going to be working for them. And I was talking to a lot of big hedge funds, and I'm just not a suit and tie type of guy. I didn't want to work like crazy hours and do a lot of modeling and do what a boss would tell me to do. So I thought I could start my own newsletter and maybe get a good job if people read it and thought I was smart, or maybe it would take off on its own. And that's exactly what happened. The newsletter became pretty popular pretty quickly. In September 2020, I launched it in March 2020. In September 2020, I rolled out paid subscriptions, and within a month, it was like at $100,000 a year in revenue, and it was just growing like crazy. And I've basically been doing that for the last 2 years, and it's kind of a dream job for someone my age. Along the way, I had some cool experiences. One thing that helped give me credibility was talking about a company called care.com early on. I've done a lot of interesting things, but the newsletter has been, my heart and soul for the last 2 years.
Yeah. So talk to us a little bit about care.com. That might get us started in some of the problems that you detect with companies.
Absolutely. So care.com was a publicly traded babysitting platform, roughly $1 billion. And my sophomore year in college, I was really interested in stocks. My friend knew this. And she's like, hey, I think you should look into this babysitting company. They claim to be doing background checks, but they seem suspect, and I'm not sure I trust them. So that's how it got on my radar. And right away, I looked for lawsuits against care.com. And you can do that on a government website called Pacer. And I saw a lot of parents had been suing care.com for like not running background checks they claimed to be doing. And there was some like local news reporting on them having safety issues. And, the most important thing for a babysitting platform is doing the background checks on your babysitters and making sure your site's safe. So I decided to test the site out myself. And if they claim to be doing background checks, I thought I'd sign up as Harvey Weinstein and see if I could get approved. So I use Harvey Weinstein's profile photo, make up an address, make up a social security number, make up an account as Harvey Weinstein, and consent to their background check. And they say, we'll get back to you in 2 to 3 days on whether or not you're approved as Harvey Weinstein. And to my amazement, 3 days later, they approved me as Harvey Weinstein on the care.com platform. And it's like, whoa, you're really not doing the background checks. They upgraded me to their highest level of authenticity. They said I was CPR certified. It was just so nutty. They weren't doing any of the checks they claimed to be doing. So I tweeted it out, and it went kind of viral, and the stock fell a bit. And the company got pissed. So the company sent like a legal letter to my house. They called my college and tried to get me in trouble. And the dean of students at my college ran an investigation into me for breaking the Wi-Fi policy and told me I needed to take the article down. And that kind of course, encouraged me to research more. So I sent FOIA requests to all 50 state attorney generals in the US for consumer complaints against care.com, and got around 1,000 pages of consumer complaints against the company, because they didn't just have safety issues. They were overbilling customers, making it nearly impossible to cancel. People were racking up thousands of dollars of care.com expenses and just needed to cancel their credit cards in order to stop the billing. And really terrible stuff. And I kept writing about them. And to make a long story short, I cold emailed around 100 journalists about all the safety issues on the platform. And 9 months later, the Wall Street Journal published a front page story about how care.com babysitters who had criminal histories had killed 8 kids they found through the platform. Wow. And then that was the downfall. The CEO, CFO, and general counsel all resigned. The dean that investigated me got fired, and the company fell a lot. And they were ultimately acquired by IAC at a big discount. And then they fix the safety issues ultimately. And for me, it showed a lot of things. First, the world's a little corrupt. Second, a lot of times companies are just lying about what they claim to be doing. So you can't take everything management says at face value. And it also showed at its best, if you're criticizing companies, if you're putting research and writing out there, it can make a difference. Not always. But this is on the long side, it's a little bit like trading pieces of paper. But if you're writing something and criticizing something, you can, and you get lucky, you can make a difference and make the world maybe a slightly better place.
So Care.com didn't own the company that did the background checks, right? Were they supposed to outsource that, or did they have their own department that was supposed to check?
So at the time, they claimed to be doing it themselves, and then you could pay more to outsource them. From what I could tell, they weren't doing them themselves, or I don't know what they were doing. They approved Harvey Weinstein, so clearly it's not that rigorous. They also got in trouble because a third party, if you're a parent, you could say, hey, Care.com, I'll pay you an extra $80. And then they said they'd contract with the third party to run the background checks. But it doesn't look like they always did that, or the background checks that would be run were that vigorous. Of course, there's a lot of nuance in the real world. So it's easy to maybe find stuff at a national level or federal level, but then all the state courts have different databases. Some you need to go in person. So running a good background check is a little logistically complicated. But regardless, you can't have Harvey Weinstein being on your platform. You're clearly being a little negligent there.
Did you actually impersonate him with his birth date or his picture?
Yeah, no, 100%. I used a photo of Harvey Weinstein. Used his real birthday. I made up an address. I made up a social security number. Just made up a fake account, but clearly as Harvey Weinstein. It would have been easy to catch. I made another one as Daffy Duck, and a third as Donald Trump. So this wasn't a fluke, but the Harvey Weinstein's the funnier one.
Okay, so you mentioned FOIA. Maybe talk to us about how you use FOIA requests to do some research, and is there a cost to doing a FOIA search or request?
So the FOIA stands for Freedom of Information Act, which allows any U.S. citizen to get government records. Generally, what I use it for is to get consumer complaints against generally publicly traded companies. And the way it works is you can go to a government agency. It can be the FTC, the SEC, the FDA, a state AG, whoever, and request documents on a company. The most common way to do it is you might go to the FTC and say, hey, can I have all consumer complaints against this company over the last 2 years? And you generally want to be as specific as possible in these requests. You can send them over email. There's not really a cost, or if there is a cost, it's generally negligible, under $100. There is a time component. So depending on the request, how complex it is, how many records there are, it can be, as quick as a week or as long as 6 months or longer to get a response. But since I filed so many of these FOIA requests and public record requests with government agencies, I kind of have a good sense on who responds quickly, who takes a long time, where records are usually going to be. And one thing I pay a ton of attention to, David, when researching companies is what are consumers saying about them? Because in the long run, the consumer interests and the investor interests are pretty aligned. It's tough to have unhappy customers in a great business. So I spend a lot of time trying to get consumer complaints to understand what consumers are saying about a company. And I'll also look online to see online reviews and what consumers are saying there. Yeah, a great example, to give you an example of how this can be valuable. There was a publicly traded insurance company called Root Insurance that went public in December 2020. And their whole mantra was, we're going to track you on our app 24/7 for a week to determine whether or not you're a good driver. And we see what times you drive, what areas you drive, how fast you drive. And this is going to allow us to underwrite insurance at much better rates. And they would give you great rates initially, but they hike your rates a ton every 6 months, even in the pandemic, 30, 40, 50%. And not only hike your rates, but they make it very difficult to cancel. So much so that consumers were writing to their state insurance commissioners asking like the insurance commissioner to help them cancel the root insurance policy. So I sent FOIA requests to a lot of state insurance commissions, and you'd get these letters like a lawyer representing, Spanish-speaking clients saying, look, my client has spent hours trying to cancel. She just can't do it. I'm asking you, the insurance commissioner, to help her cancel this insurance contract and investigate this insurance company. And sure enough, Root was doing this to tons of customers. The financials look really good. Your cohort metrics are going to look really profitable if you're just hiking insurance rates on customers during the pandemic when no one's driving. But ultimately, people do find a way to cancel, and they had a tremendous amount of churn. And I think their stock is now down like 90% since their 2020 IPO. So this is a great example where the numbers might show one thing, but if you dig into the consumer issues, use FOIA to get to get consumer complaints, you can see what's really going on.
Yeah, talk about difficulty of canceling subscriptions. Years ago, I had a subscription to a major CRM company, and it was almost impossible to cancel. I just couldn't. I couldn't figure out how to cancel it. So I went on LinkedIn and went on some of the appropriate CRM groups and complained about it. And then I got a call, and the account was canceled.
So David, I spend a ton of time looking at subscription renewals, and there's actually like a lot of nuance here. So credit cards, if you use a credit card to pay for something, it's generally easy to cancel because you can just dispute the transaction if you want to cancel, and they're making it difficult. So what a lot of scammy or aggressive companies will do now is they'll try to get your debit card. These debit cards, you can't reverse the transactions, and you also, it's different. Like you never just get new debit cards. You generally keep it for life for a long time, and there's no way to block the payments from going through. So a lot of aggressive companies, some publicly traded like gym operators, will try to get your debit card information instead of your credit card information to make it even more difficult to cancel and to stop you from billing. So that's like one red flag I always look for. Or now I always look at the terms of service on renewals. So there's another big publicly traded company, B2B, Zoom Info. And what they do is they get you into year-long contracts that automatically renew with the minimum 10% price hike. And in order to cancel, you need to cancel at least 60 days in advance. So if you email them 30 days in advance of the renewal saying, I want to cancel, you're stuck for another year with the automatic 10% price hike. And it's stuff like that might make financial metrics look good. But in my view, in the long run, it'll always come home to roost because there's just no customer goodwill there.
Yeah, well, that's a very good point. So back to your analyzing consumer complaints with the FOIA requests and so on. A sizable company is, likely to have some complaints. How do you determine how serious the problem is? Do you look at, the number of complaints relative to the customer base, or how many states the complaints are filed in?
So, it can be a little difficult, right? And here's where discretion comes involved. In an ideal world, you could get consumer complaints against every company in that industry and kind of compare versus competitors. Oh, this company has this many complaints, and a company of a similar size has half as many complaints. So company A must be doing something wrong. And sometimes that's possible. So like in the root insurance example, there was a government database nationally, like by some insurance commission, that showed root insurance was like off the charts, like 500% higher than you'd expect for their complaint rate per like 100,000 policyholders. Other times, you're going to need to use some discretion. So the earlier stages, I might be looking on online consumer review sites to see like the number of complaints, what do competitors have. I'm always trying to look at the substance of the complaint, not just the number, because if somebody's saying like, so sometimes it's very frivolous stuff. Like I think SeaWorld had a lot of people complaining about buying unlimited food and then only getting 2 hot dogs or something. And it's like, that's a little frivolous. Like who cares? That's not going to change the course of a company. So you need to read it and kind of understand the substance there. The beauty of the public records requests and FOIAs is you can often see the company's response, and the company's response sometimes is very robust and kind of discredits the complaints. Other times they kind of just admit they're wrong and give a big refund. And if you see that over and over again, that's a sign that, hey, very few people actually take the time to write a regulator. So this is probably pretty widespread. But there's just a lot of discretion reading the complaints. Another thing you get good at when you do this a lot is you realize what the credible sources are. So there's some consumer review sites, like Consumer Affairs is one of them, where the companies are allowed to pay the review sites to presumably get better treatment and get higher ratings. And it's like, well, that kind of defeats the whole purpose. While ones I trust more, like Trustpilot and SiteJabber, I think those are the better ones. There's just a lot of discretion involved. And if you just read a lot of complaints, I think you get a good feeling for it.
Right. So it seems like people are cautious about complaining to a government authority like an attorney general or a regulator, whereas they may be more carefree and, to complain to the Better Business Bureau or complain on social media. So to what extent are you concerned about complaints filed with the Better Business Bureau or, disgruntlement expressed on social media platforms?
I mean, I always look at it, but there it's, again, you want to exercise proper discretion in because any big business is going to have some level of complaints. So you want to see what do the peers have? Is it more severe than the peers? You kind of want to be looking for a pattern of conduct. So if everybody is complaining about abusive renewals, then that could be an issue. And if the market is valuing them at 20 times sales and underwriting really aggressive growth, then that's even more important. Because if a market's having something trade at 6 times earnings and there's a lot of consumer complaints, well, then the market probably understands what's going on. But if something is trading at 20 times sales and there's a lot of consumer issues, then that's really important because, these small things will have huge impacts on the stock price. If you just had 10% more churn because you didn't have an abusive renewal policy, your multiple would go down, your revenue would go down, and maybe your stock would be worth half as much. So these things, like these qualitative metrics, I think the market doesn't do a good job pricing in the short run.
Okay, so maybe changing topics a bit, you look a lot at the people involved, the management team, the executives. You look a lot at resignations. So maybe talk about what concerns you when you see some resignations.
Yeah, absolutely. So anytime you have high executive turnover, that isn't a really good sign, because if you're on a winning ship, if everything is going great, you generally aren't leaving. You want to be there for it. So, and what I pay a lot of attention to is if somebody, a CFO or chief accounting officer, resigns after a short period of time, that to me is never a good sign. So if your CFO joins and then leaves after 1.5 years, that's a red flag. That could mean there's accounting issues or some cultural problems there. And what you want to do is you kind of want to build a potential mosaic of problems. So if a CFO resigns quickly, I want to check the audit committee. Are we seeing high turnover on the audit committee as well? And who are the members on the audit committee? Are they credible? Do they have other public company experience, or are they less than perfect? You want to check the auditor. Who's the auditor? Who's the specific audit partner? Are they great? So anytime you see a high level of executive turnover, that kind of could be a sign that things are about to turn south in the near future. So one person leaving probably isn't a big deal. 3 people leaving in the last 12 months, that would be a sign that something's wrong. So I pay a lot of attention to executive turnover and stuff like executive track records and board members.
Mm-hmm. Do you look at it the other way? If there's not enough executive turnover, if a company's been floundering for years and revenues are declining, are really not going anywhere, and the same management team's been there for too long?
Yeah, that probably wouldn't be a good sign too. If then it might not be turnover. It's more evaluating the CEO and CFO. I also think sometimes companies with really big issues, you might say the word frauds here, tend to have the CEO and CFO there for like 25 plus years because they can't leave, because then issues come out, and so you're almost like married to it in a way. So I'm almost having it both ways, where somebody there for 15, 20 plus years is a potential red flag, and a lot of turnover can also be a red flag. I think the natural, term for a CEO or CFO is about 6 years or so, from what I gather. But anytime you see a lot of turnover in a short period of time, not good. Anytime somebody's there for 25 plus years, it's just interesting to me and might be a sign of, issues. Most important, though, is somebody's track record in the public markets. I always like to say winners win and losers lose. So if you have a winning track record in the public markets, I think you're going to do well in the future. If you have a losing track record in the public markets, I think you're going to do poorly in the future. And I think professional investors will look at that a lot, but retail investors don't look at it enough. An example might be Zeta Global, that was public at, I think, a multi-billion-dollar valuation. And the management team of it had literally bankrupted their last public company like 3 years after IPO. And it's like, no one's even talking about this on all the Seeking Alpha articles and Vic articles. And it's like the most relevant thing, that management's last company ended in bankruptcy after 3 years. So I want to look deeply at somebody's track record in the public markets. And we didn't really talk about this yet, but I spend a ton of time looking at board members. I always want to see, for the board members, what other public companies they've served on. Because if you have a 10-person board and 8 of the members have never served on another public company board, that's a huge issue. That shouldn't be happening. Also, if you have a 10-person board and most of these board members, the other boards they've served on, the companies have fallen 90% or 80% or penny stocks, that's also not a good sign. If there's a multi-billion-dollar company, it should, and it's legitimate and it has talented people, it should have a bunch of board members who have experience on other big companies. Not everybody, and you don't want to blow up any small thing, but I pay a lot of attention to that, because winners win in the public markets and public market losers continue to lose. And that's one thing I think everybody should pay a lot of attention to.
Yeah, you've done a great job in some of your newsletters pointing out that some of the board members have been board members of other companies that have fallen apart. So that's very interesting. Are you concerned if the same individual is the chairman and CEO, or do you think there should
No, not really. Some people say it's not best practices, but sometimes you just have a really talented person there. What I try to do when I'm evaluating a CEO is, you can look at their track record, and I think most professional investors will look at that, and that might come up problems. But I like listening to a few of their interviews, and you can just do this on YouTube. And I try to get the sense if they're like, really passionate about the business, or if they're kind of doing it for the money. And you can look in the proxy to see how they're compensated, and that might provide some insights. You can look at insider sales, and are they selling stock? Are they buying stock? I think that's largely noise, but what I like to do is I'll listen to them talk in like 3 different interviews, maybe over an hour. And I kind of ask myself this weird, funny question. Are they a mom or are they a babysitter? Because a mom CEO would do anything for the company. They'd run through a brick wall for the company. It's their heart and soul. That it's like they're married to it and will do anything possible to make it succeed. While a babysitter CEO might care about the company, but they're a custodian. They want to do a good job. They want to collect their salary. They might be focused on their next gig. And I try to get that gut feeling by just listening to them talk. And you never want to bet against a mom CEO.
Right. Is it possible to learn about severance payments that a company makes? If they're downsizing, the motivation for this question is, some years ago, there was an American apparel company that was making pretty large severance payments to a number of young women at the company. And that really sort of indicated that there was a problem with sexual harassment, because a number of young women were getting very generous severance payments. So is there a way to track that?
So generally, if they're not a C-suite executive, I don't think so. I don't think that'll be in a filing that your, 25-year-old second-year employee left with the severance package. That might be in news reporting or like local news reporting. I pay a lot of attention to turnover and chief legal officers and like chief of HR. If somebody joins and leaves in like less than 2 years, that there might be an issue. And what you do if there's an issue that you don't really approve of as a chief legal officer, your kind of only remedy is to leave and say nothing and you're out. So that's a good sign. Turnover on the governance committee might be a sign. If an executive leaves, you can sometimes tell whether or not they're leaving on good terms by the wording in a press release. So there's companies that even do this to analyze, like if you tout an executive's accomplishments over the last 5 years, and that probably means you're leaving on good terms. But if it's just a curt thank you for your service, that's not good. You can see the wording. Did they resign? Were they terminated? Did they depart? Did they depart on good terms? Did they get a huge cash compensation when they're leaving, which could be a sign of problems either on governance or with the employee being unhappy. So there's ways to determine stuff there. I don't think you can look into anybody under the C-suite and get their compensation upon leaving. There are apps though, like Blind is one app I like in the tech world, or Glassdoor is another great site to get these types of cultural issues. So any company I look at, I literally read every Glassdoor review front to back. I'll use the app Blind if it's in the tech world to see what tech people are saying anonymously. There's often like chat boards for specific industries. I think Cafe Pharma is one for the pharma industry. So if I'm looking into a company, I'll try to find the gossip site for that industry and see what people are saying there. And then you might get cultural issues like that.
Mm-hmm. You mentioned listening to a number of presentations or conference calls and kind of seeing the flow of that and how the excitement ebbs or flows. Well, one thing that I've noticed is that when the finance people, CFO or controller, when they mutter, when they speak in a very, very low voice, that's a bad sign. It sounds funny, but I've experienced this and bad things have happened afterwards. Another thing that I found I have to be careful of is when maybe a CEO speaks extremely fast. Just speaks very, very fast or gives very short answers to questions, just a couple words. That, for me, has been a bad sign.
It's funny you mentioned that. So when I say I listen to the CEO talk, I usually, I'll read a conference call transcript, but I don't spend a ton of time there. I really like more like interviews, let's say at an industry conference, or interviews with, on a podcast or something like that. That is usually what I'm trying to listen to, because I think on the earnings call, you tend to be buttoned up. Elon Musk had an interesting quote in a podcast. He said CEOs, are often like Sims characters or like video game characters on like these presentations, because you're very limited in what you say. You have a limited chat box and you're just like this buttoned up, faceless person. I try to get the more human element, which might come out if you're at an industry conference doing a fireside chat. And these videos, like, to my amazement, will usually have like 50, 100, 200 views of the CEO being their authentic self, like talking about their business. And it's always wild to me that there's going to be tens of thousands of listens on the buttoned up earnings call, and then the authentic thing like gets 200 views. That's like very listenable on YouTube. That's always kind of befuddled me. But
on the issue of people, you do a lot of work with auditors and actually delving into the specific audit partners. Tell us a little bit about how you do that and why that's important.
So the auditor is publicly disclosed and widely known based on the SEC filings. And honestly, you can Google it. But what people don't realize is in the US, there's the PCAOB, Public Company Accounting Oversight Board. And on their website, like I think it's just pcaob.us, it's really easy to find just through Google, is you can search any public company and you can see who their auditor is, who their auditors have been in the past, and not only who the auditor is, but who the specific audit partner is. And if I'm looking at something that I kind of have a gut feeling has some accounting issues, I want to see who's the auditor. Has there been turnover in the auditor? Is this auditor good? Is it credible? Is it a Big Four, or is it kind of substandard? And not only that, who the specific audit partner is. Because if the audit partner is a 25-year-old who's only audited 1 or 2 companies, that's probably not a good sign. If the engagement partner has audited 6 companies in the last 4 years and 5 of the 6 are frauds or had accounting restatements, that's also not a good sign. So this is a free thing, pcaob.us. Go to the website, search the company, see who the auditor is, who the specific audit partner is, and their track record. And this was like most pronounced for like US listed Chinese companies, where there'd be like 1 or 2 people where every single company they audit ends up having accounting issues or is a fraud or like falls 90%. And I literally just periodically check to see if they are like the auditor now for any new companies. I just know they're going to end up doing poorly. So that's one thing I look at. And the key there isn't to put too much weight on it, but try to let it fill in a piece of a mosaic of other problems. So if you have a bad auditor, not a good sign. Or if you have a bad audit partner in charge of your audit, not a good sign, but not a huge issue on its own. But if you have a 3-person audit committee and none of them have served on another public company audit committee, and you have a bad auditor and your CFO just left after 6 months, well, then you're kind of filling in a gap and kind of seeing between the weeds that there is probably a big issue there, even though any one of those pieces of information are easy to explain away. Oh, the CFO left because he wanted to, move across the country. The board, is less experienced, but you have other good people on the board. And, you can explain away like 1 or 2 of these things, but when you put it all together, I think you get a much more effective argument that there's problems there. I also, hand in hand with the auditor stuff, is I'll look at SEC comment letters. An SEC comment letter is informal correspondence between the SEC and a publicly traded company. It's public on the Edgar website under the moniker Chorus. And for that, I think that can be a sign early on of potential accounting issues. You'll see companies, change the way they recognize revenue, and the SEC will sometimes question them and be like, "How are you how is this being done in accordance with this regulation?" And oftentimes the companies will be like, "We made that change in error. We're going to change it back," and that's a huge red flag. What? Like the SEC caught you doing something, and you just say it's an error, and you're changing it back. So I try to get all these different sources of public information that people aren't using to put together these pictures and make a story that the market might otherwise be missing.
So as far as the accounting firms, when a company starts with one of the biggest, most reputable national accounting firms, and then migrates to a regional one, and then to a local one, and then to a less credible local one, that progression has been a concern. But with the very limited number of accounting professionals and difficulty of retaining an accounting firm, would you be less concerned if you start to see a company using smaller or lesser known accounting firms?
Well, it kind of depends on the size of the company. I think it also depends a little on the geography. If I saw a U.S. company that does all its business in the U.S. using an Israeli auditor, that wouldn't make sense. But for an Israeli company, that makes a lot more sense. If you're a small company, if you're a $500 million publicly traded company and you use a 2nd or 3rd tier auditor, that's almost standard because they're less expensive. But if you're a $3 billion company and you use a substandard auditor, then that's not good. So one thing I'll look for is I'll look at the 2nd and 3rd tier auditors, and I'll see who are their biggest audit clients. Because if you're a $5 billion company using a 2nd tier auditor, there might be a reason, and it's probably not just to save a little bit of money. I think oftentimes as companies grow, they upgrade their auditors, and sometimes as they shrink, they'll downgrade their auditors. But turnover for no clear reason, switching from one to another, not a good sign. There was a good Wall Street Journal article saying that when the turnover occurs also matters. If the board fires an auditor and replaces them with a new one after the annual report has been filed, that's less of a big deal. If the auditor resigns in November or December, or just refuses to sign off on the 10K, and then you get a new one at the end of the year or January or February before the 10K is filed, that's a big issue because the auditor probably ran into something that made them not comfortable with the financial statements and ended up resigning. Another thing I look at that's kind of funny, that's like been useful once or twice, is I always Google the person who's resigning or leaving or whatever and see what their LinkedIn says. And oftentimes, like, you'll find a CFO who just deletes their experience at a company from their LinkedIn, which is a sign they didn't have a good experience there, and there's probably a problem. So I'm just trying to gather information. I wouldn't put too much weight in, they don't have a big four auditor and they're a $500 million experimental company, can't invest. These are all supposed to be weak signals that taken together can be useful.
Mm-hmm. Yeah, with the CFO leaving the company, I guess you can check his LinkedIn profile to see if he really did join another company after he resigned.
Yeah, that's a great point, David. Like, if your CFO leaves to become CFO of a bigger company, not a great sign, but I mean, people get better job offers all the time. If the CFO leaves to become like a random consultant, then they probably left because there were issues at the company. So, don't rely on the press release. Google, just a little bit of Googling and snooping around can be really useful. If anything, if a CFO leaves to become I think one recently at a mid-tier company left to become a, high level person at Walmart, it's probably a sign that they actually had a talented CFO and they are good at getting talent. So, there's caveats here always. Yeah. The goal is just to get a little more information, be a little more thorough, and paint a picture.
Just one thing I'd like to contribute, if I may. Similar issue happens when you're looking at a company filing patents and using different patent law firms to draft and get the patent issued. If there's a long pendency, the time to get the patent application issued, and different law firms are involved, every year or two they change the law firms, that can be a sign that the law firm was counseling the client not to push forward with the patent application. It's not worth it. But the client says, no, I still want to do it. I want to get this patent. They go to another one, especially if it's a lower tier law firm. Yeah. And that one a year or two later says, I don't think you should spend any more money on this. They go to even a worse one. That can be a sign. Patents have limited lives, only 20 years from the date of filing. So every day that goes by, there's less value anyway. And then the technology may become obsolete. So you can look at how fast does this technology become obsolete. Maybe it's 3 years, but it took you 9 years to get the patent. So the technology could have become obsolete 3 times before you get the patent issued.
That's an interesting one. I don't spend a lot of time looking at patents, David, but I like seeing them, especially for these experimental companies, in relation to peers. So especially now with the SPAC craze and stuff, we saw a lot of more experimental early stage companies go public. And one I wrote on was Embark Trucking, which was autonomous driving software for trucks. And they had a 25-year-old CEO who was employing a lot of his college friends. There were a lot of issues. And one that stuck out the most was their competitors each had hundreds of patents. And Embark Trucking had 0 patents. And they're we rely on proprietary know-how. And they even had a risk factor. We're probably going to get sued by competitors because of our 0 patent stance. And that right there was a huge red flag that, something's up, because you say you have great software, but you got nothing patented and all your peers have hundreds. It doesn't make sense.
Yeah. Well, one thing I want to ask you about the looking at the personnel, the executives, if you look at some of the early stage Israeli companies or even mid-stage Israeli companies, some of the CEOs are involved in multiple companies. It can be a lot, maybe 3 or 4 companies. Is that a concern to you? that their
It
attention
would
may
be
be
case by
diluted?
case basis, probably not a good sign. But again, it would like what concerns me is if you have somebody involved in a multi-billion-dollar company who's also involved in like penny stock pumps and dumps, then it just doesn't make sense. And like that's an issue. I'd really like just using the SEC full text search tool to like see everything a CEO has been involved in. So to me, you're a CEO of two companies. I mean, that could be a negative, could be a positive. It could mean you're talented. It could mean you're like a money grubber. I don't put too much weight in that. It would be more like the nature of it. Have you ran like 3 public companies in the past that were like just like penny stock nonsense things? And like, are these companies doing something important for the world? Are they making real things? Or does it seem like a way just to funnel money out from investors? So if somebody is involved in a lot of public companies, I guess my kind of gut instinct or fear might be, oh, they are just running a lot of things that are trying to siphon money from investors. So you might look at like growth in share count. Is the primary purpose here to issue shares to get cash to, spend on nonsense stuff and maybe siphon off to the investors and board? Or is it to actually build something?
Mm-hmm. And then with the SEC filings, we talked a little bit about that, but my understanding is there's some apps or software or websites one can go to that will show the history of comments back and forth with the SEC. Is that right? And you can see where editing has taken place in the documents filed with the SEC.
So the tool I use, so Edgar is the biggest site that everybody can use to go look at publicly traded companies. And that's like Edgar, Google it. It's a little tough to navigate, but that's where you go. The thing I use is another SEC website, and I'm addicted to it. It's called the SEC Full Text Search Tool. This is free. You don't need an account. It's just a website, SEC Full Text Search. And what it allows you to do, it allows you to search all filings with the SEC, I think since like 1990. And I use it to find comment letters. So what you can do is you can restrict your search to filing types. So what you can do is you can do SEC full text search tool for comment letters filed in the last 6 months. Then I can see just a list of all the comment letters filed in the last 6 months and maybe come up with ideas of companies to research. Or if you know the company, you can say all comment letters with this company search, and then it will return the full history of comments. And I like reading that stuff. And even most professional investors, I don't think know about it or research it. So there tends to be like a very much a groupthink mentality on Wall Street of like how you research things and everybody sharing the same information back and forth with each other. And doing simple stuff like this, I think, can really give an individual investor an edge.
Okay. And then last issue, anything you want to talk about as far as accounting red flags or risk factor red flags?
So this is where I'm a little weaker. I think one of the important things is the channel for going public. So if a company goes public through an IPO and has legitimate people on the audit committee and a good board, I won't pay as like much attention to any accounting shenanigans. But if you go public through a reverse merger or a SPAC or stuff like that, I'm going to be paying a lot of attention. One thing I care about a lot is revenue recognition. So every company needs to disclose how revenue is recognized. And a lot of times it can be like a little complicated, or you can have some nuance in like, how do you account for refunds or like a multi-year deal? How are you recognizing revenue there? So I like looking at revenue recognition. How do they like account for revenue that's coming in? And I like then seeing if their definition is standard or not standard. Is there kind of definition of how they account for revenue used by other companies in the industry, or is it completely unique and they have a weird policy for recognizing revenue that isn't good? I think generally the finance world does a good job of like pricing in stuff that's reflected in the numbers. And that the real edge, at least in my view, is the more qualitative stuff. And that's what I tend to focus on.
Mm-hmm. So you did a good job, I think it was in your last newsletter with Olaplex. You just talked about how much more expensive the Olaplex products were than competing products. There was a huge gap, maybe a 4 times in price, difference. And, that provides a big umbrella for companies to get under and offer competing products. And, that starts to ebb away at their revenue. So even stuff like that is important.
Yeah, absolutely. And just like, by like looking at Twitter comments and Reddit comments and YouTube and all that, I think you just get like a better feel for the company. So I went in hyper skeptical of this company, Olaplex, because they were bought by a private equity firm for $1 billion in January 2020. And now, like when they were taken public 18 months later or something at a $16 billion valuation. Anytime you see something go up 16x over a short period of time, you're a little skeptical. But by doing all that research, I found like people really did love the products and they were good. And the CEO, unlike most companies I write about, I think the Olaplex CEO is really smart and talented. It's just that, you have this super high priced product. And for a lot of people, once you see like an alternative 70% cheaper, even if you love the product, you're probably going to switch or downsize some of the time. And if you're being priced at 16x sales, that's just a tough win to go against.
And maybe the last question, is there anything you want to say about companies that rely on influencers, like companies whose marketing strategy is to market through social media and to use influencers? They might be able to kind of jumpstart a brand, if it's a niche category, but, maybe they don't really have the breadth to make it a product that sells throughout the country.
Everything comes down to duration and if something is sustainable. And I think oftentimes my best write-ups have been showing something that's like a short-term good for the company or the numbers look good in the short term, but in the long run, this isn't sustainable. And yeah, using influencers or whoever to prop up your sales, I think that's good. I just don't think it leads to like a long-term brand as much as it does a short-term spikes in sales. And then when an influencer goes on to promote the next product, everybody kind of forgets about your thing. And Olaplex relies a lot on influencers. One counterexample to that might be Celsius. That was an energy drink that got really popular really fast by having influencers promote it. And, the pandemic probably changed stuff there. Generally, I think probably not a great sign. Just not because it's a bad idea, just because the duration won't be there. It won't be 20 years of sales. It's going to be 18 months while your influencer campaign is going.
Great. Well, I think we exhausted all the topics that we wanted to talk about. Is there anything else that you would like to say?
Give me 1 second to look at my notes briefly.
Okay.
No, I think we covered most of it. It's just always important as an individual investor to try to be thorough, because oftentimes the companies that are doing the most to cater to investors to try to get their attention are the worst investments. And the best companies are the ones who you won't see written up online, are the ones that aren't promotional, are the ones that are almost difficult to find. So I think just being aware of that, especially as an individual, if you're reading a lot of good press on a company, that's the one I'd probably be more skeptical of. And if there's this operator who's only given 1 or 2 interviews over 10 years that no one talks about, that's the guy I kind of want to get to know and maybe invest in. So
okay,
that might be my parting note.
Well, that was a very important point you mentioned, and an excellent session. But you imparted so much valuable knowledge to us. We really appreciate you spending all this time with us and educating us so much.
Absolutely, David. I had a lot of fun on Solution Nation, and thanks again so much for having me on.
Yes, and our viewers can learn more about Edwin Dorsey and the Bear Cave. You can Google him, look him up on LinkedIn or Twitter. And I subscribe, and I recommend his newsletters very highly. So, okay, well, thank you so much. We really appreciate it.